Hello traders, it's Thursday, January 9th. This is John Kicklighter, Chief Strategist for dailyfx.com. Here to give you your FX market wrap up for the past 24 hours of trading and an out for what we can expect in the 24 hours ahead. Now this past 24 hours, what I would consider to be the lull of the trading week, at least fundamentally speaking, and that would indeed be the case from a price action perspective. We didn't really have much in the way of definitive movement, although we did have some notable standout action, not necessarily in all the majors, but a few moves from a couple currencies here and there. You also had some pretty big moves in the treasury market. So we'll talk about those particular developments, but in the coming 24 hours, we have much greater potential for heavier swings, at least those that would be based upon a fundamental backdrop, because we start to get into the deeper fundamental waters. Now, in this past 24 hours and in the next 24 hours, and actually in the next 48 hours, I think one of the top currency pairs to keep a close eye on will be the EURUSD. Now, in this past 24 hours, we have been, actually this entire past week, we've been talking about the lack of a clear and distinct risk theme for this particular pair. This, in contrast to, let's say, the yen crosses or the S&P 500, is far more sensitive to the relative monetary policy approach. These are two of the major fundamental themes that are currently defining the bigger picture in the FX world. And when we look at the EURUSD, obviously we're talking about the outlook, or at least the market's perceptions for the outlook, of the ECB versus the Fed. Now, in this past 24 hours, we were talking once again about the Fed. Prior to that, we were talking about the ECB because of the inflation figures that we had, the Eurozone core inflation figures that we had on the previous session. All right, but this past session was actually once again back to the Fed. What we were seeing from the Fed was we had two particular pieces of data that, or three actually, we'll say three pieces of important data that would tap back into the implications of the taper, the pace that we're going to see, and what it means eventually for the market. Now, I go into much more detail about the taper and the Fed's policy bearings, how to measure it, and what it means for trading in today's strategy video, so check that out. But for this particular past 24-hour period, we were looking at a couple key pieces of event risk that were tapping into this theme, that were helping to stir the pot, so to speak. Number one, and the easiest one for the markets to recognize, was the ADP employment change. Now, this ADP employment change was better than expected. The 238,000 jobs that the market or the private payrolls were actually printing was much better than was projected at about 200,000, and was the biggest increase since November 2012. All right, this is not a perfect measure or perfect benchmark for non-farm payrolls, which comes out actually on Friday, but it does set a pretty good tone. And we know that when we see a positive indicator that puts us at a multi-year high like this one did, that it does encourage expectations of at least an assumption of better than expected labor market conditions, or improving labor market conditions. We won't say better than expected, we'll say improving labor conditions. And that's exactly the kind of consideration we need when the prevailing expectation is for the Fed to actually maintain its taper policy. All right, remember, the bearings that we have now for the Fed are not what benchmark can we hit to actually get to the taper. All right, we're already over that cliff. Now the burden is to see what kind of data actually would stop the taper. We don't necessarily have anything on the docket this past 24 hours that would stop the taper. In fact, it actually encourages the taper. So that ADP figure, in a risk perspective, I'm going to mark red because it takes away stimulus, which is negative for risk, but for the dollar, it's bullish. The second event, all right, I would actually say is the 10-year Treasury note sale. In a good reflection that markets are getting back to what we would consider to be normal, away from the distorting effects of the stimulus program, particularly from the Fed, we have seen that the 10-year Treasury yield has actually been sold or auctioned off with a yield of 3% or above. We haven't seen a 3% yield on a 10-year auction since way back in May of 2011. So a return to normal that we're already starting to see take place in the 10-year yields, which is the purple line here. We actually watch these, we should be watching these pretty closely, the yields on 2-year and 10-year and really all across the curve, because these are actually amongst the best measures right now of what the market presumes or expects and is pricing in for the Fed and the impact that can have. Because once this starts to get a little bit more severe, once the focus intensifies on the taper and what its impact can be, that's when you're going to start to have bigger movement in the dollar and inevitably or eventually in risk trends. Okay, so that was the second big mover on the day related to the Fed and taper and dollar. The third, and the one that most markets were paying attention, or most market participants were paying attention to, at least in the FX world, was the FOMC minutes. Now, these FOMC minutes were quite inflammatory. We heard things like many of the policy officials supported a measured steps to reduce the stimulus program as currently underway, the QE3. They suggested that there were waning benefits from QE. All right. The assumption were that we were moving back towards a 2% inflation target. Labor market conditions were improving. That's all supportive of a continued taper. What I found most interesting was that the suggestion that the Fed, some of the Fed members, started to see a risk in the connection between QE and the financial expectations, the financial market stability. That is a cost. All right, that is a concern, and that is reason enough for them to continue along the way, and that's probably going to be the active catalyst for the taper going forward, not because of remarkable growth or an impending inflation threat. It's more about the costs, and as long as those costs are talked about, we're going to stay down this path. So why, if this was the update, would we not see a tremendous rally in the US dollar? Why did we not necessarily see a sharp drop in the S&P 500? All right, this looks a lot like the I don't care response from the S&P 500 December 18th, which was a liquidity issue problem 3 days before or 3 trading days before the holiday. This is still not the level of intensity that we need to see spill over to these more prolific themes. That's why we take a look at something like the Treasury yields. Now, if you look at the 2-year yield, there was actually a sharp jump in those 2-year yields. We moved up to a multi-month high after this data was absorbed, or after these comments were absorbed. All right, we're starting to see it's having a greater and greater impact, but it's not yet to the point where we're going to say this is a risk theme. All right, we have to separate the influence here. But there is still, before we get to the risk theme, and I do think that risk themes are eventually stirred by this, there is still a lot of influence in the improved backdrop for stimulus, all right, or a reduction in stimulus for the US dollar versus its counterparts. And that's why I'm going to look at the EURUSD. Because the EURUSD, when we line up the Fed against its counterparts, we have the ECB on the opposite end. All right. Tuesday we had the CPI figures, which were a sharp drop in the core inflation report. In fact, it was the lowest that we've seen in a long time from the core inflation report. Subsequently, this past session, we had a confirmation of a 12.1% unemployment rate in the Eurozone, which is actually a record high, tying the previous month. So conditions are not very good in the Eurozone, and to some extent, that supports the same kind of policy approach that the ECB took back on November. Back in their November rate decision, they actually announced a rate cut, a surprise rate cut to many. All right. So heading into Thursday, there's a strong inclination amongst the policy watchers, the rate watchers, that the ECB could be ready to do something else. All right. And if they start to extend their easing program while the Fed is tapering, this big benefit of a reduced balance sheet for the Eurozone and an increased balance sheet for the Fed, which would drive the EURUSD up, is going to start to turn. Now, the problem is that when it comes to the stimulus program for the ECB, there isn't necessarily a strong enough push, or at least the correct push, necessary to push the ECB over the edge. All right, we talked a little bit about this on Tuesday, or in the wake of Tuesday's event risk, but inflation figures are not necessarily going to incite the ECB to the next steps, because we can't get a rate cut. All right, they've already cut to 0.25%. That's going to zero really does not have any material benefit. So that final rate cut is unlikely to happen. There's been discussions about zero interest rates on deposits or negative interest rates on deposits, the deposit rate, and there's also been talk about a directed stimulus program. Those are possibilities, but remember, when we get to negative interest rates, that is a really an experiment, and a dangerous one at that. And we're talking about something like reviving the LTROs, or the unusual QE that the ECB has been pursuing. It doesn't necessarily have the support that it did back when the LTRO 1 and 2 were actually inducted. So here's the inflation figure in the Euribor. All right, we watch these as the market rates, and you can see that they follow pretty well. The problem in this relationship, though, is that we don't have the financial pressure. All right, and the financial pressure is what actually encouraged or incited the ECB to its move. As you can see here, this is actually sovereign credit rate swaps. All right, and as you can see, they are actually at multi-year lows. They're lower than they were before the crisis began in the Eurozone. So there's not that pressure. Furthermore, we looked at the bond spreads, or the yield spreads, for sovereigns. So the credit financial risk spreads aren't there. The yield spreads are exceptionally low. In fact, we just saw shorter end Italian and Spanish bonds, government bonds, had actually hit the lowest on record. The 2-year Spanish bond and the Italian 2-year Spanish bond. All right, and those yields are reflections of markets' assumptions of risk in those countries. So we don't really have the financial pressure there. What do we take away from that in the euro price action? Well, if the market is pricing in an immediate movement from the ECB, the fact that they are going to potentially stay their hand could lead to a rebound in the euro, where the euro is deemed to be oversold. Now, I don't think it's very oversold against euro USD. It did pull back, but I would not at all venture to call it meaningfully oversold. But if there is some pent-up expectation of that negative outcome for a QE or something along those lines, there might be some relief rally there. I think that the consensus is not necessarily that relief rally or that stimulus move is coming, but there's a threat of it in the future. All right, it's still in the future. If the ECB is going to consider this move to introduce something that helps support financial stability and even potentially growth, then they're probably going to talk about it, or at least President Draghi is going to talk about it in his press conference after the rate decision. So we're going to be watching this very, very closely. If they suggest that there is a greater probability of a QE move later down the line, that can also instigate a drop in the euro. Now, if I'm looking for a drop in the euro, let's say they go for a QE, or let's say that they give a clear bearing of QE in the future, I actually like the euro dollar a lot. Why? Because it sets a very stark contrast in the direction that these two monetary policy groups are taking. Because as we know, the Fed is already at the extreme dovish, and it's starting to move back towards neutral. All right? And if the ECB continues its march down the curve towards dovish, that would be a bullish dollar bearing and a bearish euro bearing. All right? So I do like this pair a lot under those circumstances. The euro USD isn't the only place that we would have a big benefit for that kind of move. We can also see the euro Aussie, which is actually a trade that I have on. Its RBA is arguably even further down the dovish part of the curve, at least the market's perceptions of it, because they have just come off of an exceptionally aggressive rate cut regime. They haven't even made the turn to neutral yet. So as we start to see any kind of evidence that they do, that is going to be a material shift for the Aussie dollar, something where the Aussie dollar starts to recover ground, and the Aussie dollar has suffered some very big declines against most of its counterparts, and especially here in the against the euro. All right, so that is a good contrast as well, though the Aussie dollar isn't fronting much of the bill on its own. Now, where would I look for the euro if it's going to have something of a rebound? Take a gander at the euro pound. I think this has great potential. We just recently dropped below this 50% fib of the July 2012 to the July 2013 bull wave. All right, we just slipped below that midpoint this past session, and we are coming near the bottom of these two descending channel formations. Now, that being said, you do have a good reason. The euro is relatively weak. The pound has seen an exceptional increase in its interest rate expectations, especially over the past 6 months. The pound has enjoyed these and reaped these benefits across the board, but the pound has overdone it somewhat. And if there is to be a rebound from the euro, and we're looking to see some of that negative premium worked off, this is a good place for it to happen, because the pound, on the other hand, is at the extreme end of the hawkish expectation curve and is coming back a little bit towards neutral. That would set up a good backdrop for the euro pound for a possible bounce if the euro is going to see some recovery. All right, so we're making different scenarios. All right, we have trades for different scenarios, and that's what we need to do. We need to see, because everything is a probability, there's no certainty. Look for the different scenarios that play or cater towards a certain outcome. All right. Now, I'm talking about the pound, and the pound indeed is going to have its own influences. I've been watching the pound dollar for some time, and I think it has some of the best potential. Once again, talking about the dollar at the extreme end of the dovish curve and starting to work its way back, and the pound on the opposite at the very hawkish and working its way back from the opposite side to neutral. That is a good possible driver for the pound dollar to the downside. This is loosely a head and shoulders pattern, though it's not very well formed. But if we need, critically here for me, a 62.50 break. All right, we can get a break to the downside, start to see this trend line break, and that is encouraging certainly, but I need that technical break of 62.50 before I am significantly confident in this trade. I also need to see the fundamental themes that support it, and those fundamental themes are a realization that the Bank of England is actually coming back in those expectations. So I need to see what this graph shows me, the pound and the Bank of England's interest rate expectations working back towards neutral. All right, that will give the pound a sell-off. The dollar is already in a good position to advance, everything else being equal. And if we get something that actually instigates the market's retreat on interest rate expectations, we have something that can really drive the pound dollar to the downside. Now, we do have a BOE rate decision in the coming session, but you have to be careful because, as we know, we should know well by now, the Bank of England does not release a statement when it does not change monetary policy, or its statement's actually just a very short wrap-up. They don't give us any kind of forward guidance from this event, and that being said, the market doesn't really move very far with its interest rate expectations, and thereby does not move very far when we're talking about price action. All right, so if you're looking at something like the pound dollar, where I think we really leverage the influence of monetary policy, it's going to really be a lot of legwork by the dollar. Just like with the euro pound, if we're talking about the relative monetary policy, it's going to be a lot of legwork by the euro, not necessarily the pound. All right, there's a very outside probability, it's a very low probability that the Bank of England does something, but they're unlikely to do it because there's no policy changes really coming. So the only thing they could only reasonably do is alter their forward guidance, which they typically align with the quarterly inflation report or a similarly important update time. All right, so expectations for the Bank of England should be set relatively low, though you could also see data like the UK trade balance can have a material impact, because remember, the expectations are pricing in perfection when it comes to interest rate forecasts, and that means any data point that comes out that undermines those expectations are going to reduce interest rate forecasts and reduce the pound's premium. All right, so it's difficult to say what actually catalyzes it the farthest, but it does happen. It does erode each time. All right. So a couple other pound-based pairs that I'm watching. You know that I still like the medium to long-term view of this pound Kiwi, especially it starts to make this turn higher. But the problem being, the short to medium term, if that pound rate expectation starts to pull back, this can be somewhat disruptive as a potential pound Kiwi move to the downside. I like better a pound Aussie move to the downside because I do think that the Aussie is a little bit more extreme in its expectations. Interestingly enough, when we're talking about the yield forecast, and the Kiwi and the Aussie don't necessarily have a lot on the docket ahead of us, but when we're referencing these rate expectations from the market, the RBA is moving up from a very dovish perspective, but it is actually one of the favorite carry trades. The RBNZ is up here at the very hawkish end, all right? And it has generated limited return from that hawkishness. I think perhaps one of the better places that it's seen those kind of gains is where the currency's already been weak, the Japanese yen, who's very, very dovish, and it's getting actively a selling pressure on the yen because of that. But the Kiwi has only limited gains here. Compare this to a euro yen or a dollar yen, and the Kiwi yen's gone absolutely nowhere. All right, so if the Kiwi rate forecasts from their approximately 125 basis points priced in over the coming 12 months have shown a peak and start to pull back, which they have recently, if that pulls back, and that pulls back in a meaningful way alongside a at least modest pullback in risk trends, then you have a possible breakdown of the Kiwi yen, all right? Because the yen crosses will be hurt for those risk trends. The Kiwi will be hurt because it's coming back from an exceptionally priced in yield forecast. This is a very interesting technical pattern, and it has potential to be a continuation pattern and a reversal pattern. The problem with the continuation pattern is to see a aggressive move, which a breakout would be, is going to be more difficult to accomplish. Why? Because we already know what the Bank of Japan is doing, and we're already marching that way under current presumptions. All right, to see a really strong risk-positive move is difficult to engender from these markets because we're already exceptionally pricing in risk. All right, but it's much easier to see a more dramatic reversal in risk trends. It's a lower probability, but the potential from that kind of move is much greater. I've actually started to take a closer look at the Kiwi dollar. As you can see, this was had moved its way up to the top of this descending channel. This is an 8-hour chart. And it had a possibility of breaking to the upside, but we're talking about here two different policy views. While the New Zealand yield is already high, and it's the highest amongst the majors, the dollar is starting to see some improvement on that curve. The Kiwi's already really at the pinnacle of that curve, unless it's really starting to price in aggressive rate hikes from the RBNZ, which would be difficult given the global perspective. So now we're starting to talk about the possibility of a pullback. We have congestion here between 83.15 and 82.50. All right. If we break one side of these, this can be a good short-term breakout with potential for follow-through. Now, I like fundamentals for follow-through to actually give us some drive. So a move to the downside in Kiwi dollar can be encouraged by the dollar side of things. And if that were the case, it would have to go into Friday's and off-farm payrolls because it's a little bit complicated for follow-through. But if it is a risk-based move, if equity starts to drop off, that is plenty of encouragement for the Kiwi dollar to drop to the downside. So a trade to take into consideration. Risk trends have great potential going forward, but as I have said and repeated constantly, you have to be careful about trying to trade risk trends that aren't necessarily there yet. They might eventually develop, but until then, a lot of it is just speculation, and we've seen some pretty consistent pullbacks turn into aggressive rallies. So we have to be careful. When you're looking at pairs like euro yen, or you're looking at a pair like pound yen, or you're looking at even the tamer risk themes, especially the tamer risk themes like euro dollar, or dollar yen, or Aussie USD. All right, you need to see those true risk themes come through. All right. Otherwise, we're going to see something like Aussie USD, and it's going to be talking about who is the most overburdened yield forecast and which one has the most room to recover, and is it recovering in time? That will be more important to something like the Aussie USD. And that's why I'm looking at with the Aussie dollar, and that's why it's difficult for me to say that I really like a trade on the Aussie dollar, because technically it looks like it has that break of this channel, pulled back, tested former resistance loosely as new support, and can thereby see a move forward, but it's the fundamentals that carry follow-through. It's not necessarily the technicals. The technicals present the trade. They offer places to put stops. They offer the target for an entry. All right, but the follow-through is more of the realm of the fundamental. All right. So we'll be watching in the upcoming session these relative monetary policy considerations, especially with the ECB rate decision on hand. Do remember that we have the non-farm payrolls on Friday. That is a big piece of event risk for the dollar side of things. So we're going to be talking about ECB decisions, Fed decisions, and the speculation surrounding those. And you should always keep the risk trends at least in the back of your mind, because these fundamental themes all work in conjunction with each other, and that's where the biggest trades are going to come out. But in the meantime, you don't need those big volatile risk schemes to see trades play out on something like a euro dollar or a pound dollar, even a dollar yen or a euro pound. These are kind of the trades that can develop all on their own with relative monetary policy. So keep these trade setups in mind, and also keep the big fundamental picture in that strategy. Good luck trading out there, guys, and we'll update you on the final 24 hours of this week tomorrow.